Hey, it's Patti Scharf, CPA and co-founder of Catching Clouds, the leader in e-commerce accounting. And today we're going to talk about a podcast episode from The Amazing Seller. It was posted on November 7th, and it was called Huge Tax News for Amazon Sellers, Game Changer, which of course is very exciting. Everybody wants to know about game-changing tax legislation. And somebody brought it to my attention and they were like, is this really legit? Because if this is true, this really is a game changer. So I thought I would break it down for everybody in this video. Make sure you stick around to the end. There are some interesting things I found along the way that I think you will find interesting too. All right, so let's get started. All right, so I want to give you a little bit of background. If you want more details and background, go check out the video I did this summer called Do the 2018 Tax Law Changes Affect When You Can Deduct Inventory? That's what this whole thing is about. But when I did the video, I kind of did it based on gut feel and not too much research or anything like that. I didn't pull out my tax books and dig through and stuff. I just did it based on what I knew about stuff at the time. So when I heard this podcast, and basically what they were saying was, you can now deduct all of the money that you spend on inventory. So if you're buying inventory, you don't have to classify it as inventory. You can write it off immediately. You don't have to match it against the income that you receive. It's instead of being inventory, it goes straight to cost of goods sold. All right. So I did that video. Basically, my argument was, no, that's not right. And so, because I am not a tax expert, I wanted to double check myself and make sure that the advice I was giving was accurate and that I actually knew all the facts and stuff. So I went on a little journey to figure out everything I could about this tax law and how it would impact Amazon sellers. So here's the actual issue. Before this tax law change, if you had more than $5 million in gross receipts, you were required to file as an accrual-based taxpayer. If you had an inventory business, so you're selling retail, you're selling widgets and things like that, it was $1 million. So a lot of people who maybe wanted to file as cash basis taxpayer weren't allowed to because their sales were too high. Okay, so they raised that threshold up to $25 million. That's average gross receipts over the last 3 years, okay? So tons more people are able to file as cash basis taxpayers. Now, the question is, what does this mean for you? Why do you even care about filing as cash basis versus accrual basis? The deal with cash basis is you report your income when you receive it, and you report your expenses when you pay them. So a lot of people think that if you're spending a lot of money on inventory, you're laying out that cash, those are expenses, you get to write that all off as a cash basis taxpayer. That's not exactly true, because costs for inventory are what's called capitalized costs, which means it's not an expense, it's an asset. It's something that you own, it's something of value that you own. And you get to just kind of expense that a little bit over time as you sell the inventory, okay? Okay, so here is the meat of the issue. If you switch to cash basis, can you now deduct all of your costs for inventory as cost of goods sold when you pay for it? Okay, that is the question. So let's get back to the podcast. This was 100% what they were saying, is that now, because of new rules and things like that, the IRS had provided guidance that said, yes, you can absolutely write off all of your inventory when you buy it as a cash basis taxpayer. As I mentioned before, in my gut, not really sure that's right, but I am not the queen of all things tax, so I just started diving in and seeing what I could figure out about it, okay? I went to some of my community boards, asked some CPAs, hey, what's your opinion? And I did this also in the summer, and both times I got these kind of non-committal responses, or yes, you can definitely write it off, and also yes, you absolutely cannot write it off. So I'm like, okay, thanks for clearing that up for me. And while I was kind of waiting for a response, I was continuing to do more research and I was looking for articles and things like that. And one of the things that was really glaring to me was that there was like the silence on this topic from like Journal of Accountancy or CPA Practice Advisor or any of the like main trade mags, like that nobody talked about it. So I'm like, I don't think that, like, if this was as huge of a deal, if this was a game changer, then there would be a lot of talk about it. And there's just not. And I continue to have conversations on e-commerce fuel. If you don't know about e-commerce fuel and you're an online seller, like 7 figures and up, man, you got to go check them out because they have the best conversations in their community forum. Those people are like badass, I have to tell you. Because I started just having this out loud conversation with them online, and I got way deeper into what the issues were than any of the conversations I tried to have with my CPA friends. And here are a couple of things that we kind of fleshed out in this process. Oh, and hat tip to Reese, who found this amazing letter from Ivins, Phillips, and Barker that kind of broke everything down and was really intelligent and approached everything in a really smart way. I will give you a link to that letter down below because it's just awesome. And you'll want to share it with your CPAs. All right, so here is my journey weeding through all of this tax jargony stuff. I'm going to try and interpret it for you. All right, so I took a look at IRS Revenue Procedure 18-40 and just kind of break it down a little bit. All right, so the section that everybody really cares about is 319. And in this, what it says is, okay, you don't have to treat it like inventory. You don't have to like do all these other funky calculations like uniform capitalization rules and blah, 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 blah. That's actually in an earlier section. So you don't have to treat it like inventory. You have 2 other options. The first option is to treat it as non-incidental materials and supplies. And the second option is to treat it according to the taxpayer's method of accounting. All right, so let me start with the first one. Non-incidental materials and supplies. Basically, it's kind of the flip side of incidental materials and supplies. Incidental means, it's incidental to everything. It's kind of immaterial, just expense it immediately. Okay, so that's what, like everybody who says that you can write stuff off right away, if it was incidental materials and supplies, I'd be on board with you, but it's not. It's non-incidental materials and supplies. So it says, yeah, this is it's kind of a big deal in your business. And so you don't have to like capitalize it, but you can only write it off at the later date of when you pay for it or when it's used or consumed. So that's pretty much exactly what everybody was doing beforehand. Like you would hold on to it, and then as you sold the product, you would expense it. And I'm going to talk more about that and maybe some loopholes and stuff in just a couple minutes, so hang around for that. The second option was to use the taxpayer's method of accounting. And first they talk about having applicable financial statements. That's actually like some legal jargon, and it's kind of the equivalent of having audited financial statements or filing some reports with the SEC and stuff like that. Like that's not going to work for anybody, and it doesn't matter because the vast majority of small businesses don't even have that anyway, so it doesn't matter. But it does say, or if you don't have applicable financial statements, then just use whatever method is cool, whatever method you're using with your accounting system. Yeah, just use that. Like whatever you use for financial purposes, that's legit to use for tax purposes. So here's where the hair on the back of my neck starts standing on end, because literally what it's saying in there is it doesn't matter what you do. You can have like the crappiest records in the world, and that's okay. As long as your crappy records are consistent between tax and book, that's fine. So I think this is where everybody is really jumping on board and saying, hey, if I don't keep track of inventory for book purposes, then I can write it all off immediately. Now, I'm pretty confident that the IRS did not intend to have everybody just writing everything off. But that doesn't mean that the language is not completely ambiguous and that there's not a lot of room for interpretation. So I'm going to give you more of my opinion a little bit later on, but I would just say this is what I think has everybody kind of in a flurry. All right, so we came up with one potential loophole, and this was basically what they're saying is, okay, it's not inventory. It is non-incidental materials and supplies. So because it's not inventory, it doesn't have to wait to be written off until the products are sold. It just needs to be used or consumed. So what does used or consumed mean? Does it mean that when raw materials are used up and turned into finished goods, that it can be written off at the time that it turns into finished goods? Does it mean that when you send your products to Amazon and they slap a label on it to finish the product, to turn that into finished goods, is it okay? Is it considered used and consumed at that point? I don't know. These are questions that people are raising. I think that there is not sufficient guidance yet out from the IRS to make a distinction one way or the other. I think if you're going to make an assertion on one of these, you want to have some pretty strong evidence, support, and argument for taking that position. But I also don't think that it's absolutely black and white one way or the other. Loophole number 2 is related to what's called a de minimis election. So maybe you know about this when you're talking about fixed assets. So let's say you buy a computer and it's $3,000 because it's a really, really nice computer, okay? You can't just expense that. It's not an expense. It's another capitalized asset. So that becomes an asset and you get to take a little bit of expense every year until the entire cost of that asset has been depleted. That's called depreciation, okay? That's what that is. So, but people who have like a de minimis threshold basically on fixed assets, if you have what would otherwise be an asset, basically the IRS is like, yeah, that's small enough. Like, don't worry your pretty little head about it. Just write it off. Okay. Inventory doesn't have a de minimis election, but non-incidental materials and supplies does. And that limit is $500. So I know a lot, in fact, probably the vast majority of e-commerce sellers are not selling things that are more than $500. So you could conceivably expense all of your stuff under that de minimis election. But again, it's one of these situations where if all of your products are, let's say, $50 and you're a $5 million company, well, that $50 becomes a material part of your business, even though it's a small dollar amount. So I would feel very uncomfortable taking that position. Doesn't mean that there's not a gray area. All right, so let me give you a few things to keep in mind before I get to my final thoughts and conclusions. The first thing is, if you are an accrual-based business, you have to elect to make the change to cash basis. The IRS is expecting you to continue filing accrual basis forevermore. You have to request that change. Now, there's an automatic acceptance of the change that's part of this law, so you can go ahead and just request it and you'll be granted it. If you ever decide to change back to accrual basis, again, you'll have to ask the IRS for permission to make a change. The way you make a change is by filling out Form 3115. You can either file it before the beginning of the tax year, which would have been December 31st of 2017, so it's too late, or you can file it with your tax return. Just tell your CPA, you should be discussing this with them anyway, they should know what to do, but that would need to get filed with your tax return, all right? The second thing to be aware of is that you cannot be flipping back and forth between cash and accrual based on whatever happened that year. You have to pick a method and go with it unless there's some extraordinary reasons why you might want to switch from one to the other. Okay, so don't be thinking that you can just change your mind every year. It doesn't work that way. And again, you have to ask permission from the IRS, and if you don't have a good reason, they may not allow you to do that. The third issue, and I think this is the most important issue, is that keep in mind that your costs for product are a seesaw. So like you buy it and you have more inventory and you have no cost of goods sold, or you expense it and then you have some inventory and some cost of goods sold, or you expense all of it and all your amounts are here and then you've got no inventory left over, okay? So what's going to happen is if you take a full deduction this year, that means next year when you have income, you're not going to have any more deductions to take against that unless you buy more inventory. So you can control your expenses more by picking and choosing when you're going to have this outlay of cash and how you're going to time that. You have more control as a cash basis taxpayer, but at some point you're going to have to pay the piper, unless your business just blows up, which nobody wants to have happen. So just keep that in mind. If your inventory is growing year over year, it may be a good deal. If it's shrinking, it may be a bad deal. So just kind of keep that in mind when you're deciding what to do. All right, so my last comment about this whole thing, my personal opinion is I think that yes, there may be some gray area. I certainly do not think that this is a game changer that everybody can suddenly deduct all their inventory. I don't think it's that black and white. I think it's a little nerve-wracking to think that like all of my clients might be taking that advice and leaping over and starting to deduct all their inventory. It's a little scary for me, especially because in the revenue procedure itself, it basically says something to the effect of, okay, well, if you change your accounting method, just be aware that it doesn't mean that we can't audit you. And if we do audit you, that you have to support your position and we may or may not agree with you. So if you change at your own risk. So that right there kind of stresses me out for everybody. So with all that said, I'm not going to tell you what to do. You need to go talk to your CPA. Please, please, please talk to a CPA before you make any kind of sweeping changes and things like that. Make sure that they understand the issue, you understand the issue, and you know all the risks involved before you go into it. All right. I am not the one signing your tax return. The only tax return I'm signing is my own. So I wish you the best of luck. I hope this helped. If you like this video, please like, comment, and share. If you haven't already, please subscribe, and I'll catch you later.